welcome to Cafe Mutual YouTube channel. Friends, so far we have seen fund managers following different style of management like growth, momentum, value. But now we have a fund house which will rely on mathematical analysis to pick stocks. Yes, you heard it right. I'm talking about Alpha Grep Mutual Fund, the new player in the 83 lakh crore mutual fund industry. To talk more about it, we have with us Bhautik Ambani, CEO and Director Alpha Grep Mutual Fund. In the past, Bhautik was the Executive Director at Avendus Capital, where he was instrumental in growing business to the largest offshore hedge funds in India. He was also recognized as one of the most promising professionals in India in the 40 under 40 category. He has also worked with Ambit Capital, Kotak Wealth Management, and Mirae Asset. Bhautik holds an MBA in finance from SP Jain Institute of Management and a Bachelor of Management Studies. So let me welcome Bhautik to the show. Welcome to the show, Bhautik.
Thank you so much, Nishant. It's a pleasure for me to be here today.
So Bhautik, so my first question must be on everyone's mind. Alpha Grep is known for algo-based model in alternate space. However, mutual funds are very different product, right? We have seen even seasoned fund managers underperformed over prolonged period. So why do you believe the algo-based model will perform well in the mutual fund space in future?
Sure. So let me answer it this way. See, I actually think that precisely why quantitative investing deserves greater intention. See, most active funds ultimately rely on human judgment. Humans are susceptible to behavioral bias, emotional decision making, and contingency or consistency challenges. I would put it that way. Now, our philosophy is different. We believe that investing should be driven by data, research, and a repeatable process rather than opinions. So let me give you some background here on Alpha Grep. So we are a 16-year-old firm. We've been building, refining quantitative models across multiple market environments. Just to give you some numbers here, we today trade across 30 exchanges worldwide as a group. We pretty much trade all the traditional asset classes. So we trade equities, commodities, currencies, interest rates. Today, as a firm, at a group level, we have close to 500 employees, of which around 400 plus are engineers. We can proudly say that it's a company which is actually built by engineers. Out of the 400 plus engineers that we have, close to 250 of them are what we call quantitative researchers. So, in simple terms, these are the guys who come up with strategies for us at a group level. Um, Now, again, considering we rely on quantitative analysis, all our strategies get converted to algorithms. What is very, very critical is technology and data. So there's a separate central team of close to 150 people who are only managing the technology infra for the company. So if you think about it, there are professionals who are continuously researching signals, testing hypotheses, improving models, and that's something which is happening on a continuous basis. And see, the question to ask is, can any model outperform every year? Of course not. Markets don't work that way, right? But our belief is that a disciplined, systematic investment process has a higher probability of delivering consistent outcomes over a long period of time. Because what it does is that it removes emotions, and it follows like an evidence-based investing approach rather than intuition. So ultimately, our objective isn't to predict markets perfectly. It is to basically make better decisions on a consistent basis.
Okay. So globally, quant model is very popular. So what are some lessons that you have learned from developed economy that you will implement in India?
Sure. So, Nishant, the way I look at it is that let's look at US, right? And the reason we look at US is ultimately whatever happens in the US happens with some lag in India. So as a trend, if you look at the US, maybe around 30 years back, passives was close to 1% of the industry UM there, which 20 years back, let's say, grew to close to 18-19%. Today, passives is more than 55% of the industry UM out there, the mutual fund industry UM. Uh, one of the largest growing categories now in the US is something called active quant. These are basically funds which are still model based, quantitative, what we also call smart beta to a certain extent. All this category of funds are one of the fastest growing categories in the US now. And when we look at active mutual fund AUM data, for the last 5 years in the US, they've been losing assets. Whereas on the other end, ETFs, which is a combination of, in some sense, passive funds and active quant, has been growing leaps and bounds. Okay. Now, the question to ask is, why is this happening? And we believe one of the biggest drivers of this is technology. Because if you think about it, what technology has led to is that it's democratized information. What does that mean? It means that pretty much everyone now has access to the same data information at pretty much at the same time, which means that or firms that can access a wider set of data and process it at a certain clip, right, will ultimately have an edge compared to humans to a certain extent. So that's where this difference kind of comes in, and what kind of gives us a lot of confidence of what's happening globally versus what we are potentially seeing in India, and where we see that potentially things will go going forward. Because when we look at the Indian entire mutual fund space, uh, we are we're actually looking at pretty much reverse numbers in terms of market share. So discretionary is one of the largest market shares in the industry today, where actually fund managers are managing funds. Passives is another 15-20%. And what we call active quant is as good as non-existent. So
Very
we think this is a big blank space,
very
which will get
interesting.
filled up in the next few years or decades.
Very interesting, Bhautik. So, Bhautik, my next question is about your Alpha Grep Mutual Fund. So, I have seen that
Sure.
many new fund houses begin their journey with flexi cap funds. But Alpha Grep Mutual Fund has started multi-asset allocation fund instead. So, why this
Yeah.
is happening? What's the rationale?
Sure. So see, when we looked at, where investors need, kind of the most help, right? So see, choosing stocks is only one part of investing, but deciding how much to allocate to equities, debt, commodities at different points in time in the different market cycles, to our mind has a bigger impact in terms of long-term outcomes compared to just choosing the right stocks. So when we think about it, in our view, most investors tend to struggle with this decision. Should I be reducing equity? Should I be buying gold? When should I increase debt? Should I wait or invest now? So, our first offering is designed to solve for this problem to a large extent. So what we are trying to do out here is a dynamic multi-asset strategy, which basically allows the portfolio to respond to changing market conditions instead of remaining dependent on a single asset class. Because we believe that, particularly relevant in today's environment where economic cycles, interest rate cycles, geopolitical events can change things faster than they did a decade ago, this is the need of the hour in our view. And Nishant, when you look at the data, there were a lot of historical assumptions that we would play with in terms of correlations, right? Like correlation of equity versus fixed income, correlation of equity versus gold. A lot of these correlations are breaking. Look at the last few years, we are not seeing that these correlations are, the same way as what we used to see for decades. So things are changing very quickly, which means that by just relying on certain historical assumptions may not give us the best results going forward. And there is enough and more empirical evidence which basically proves that choosing the right asset allocation is extremely important in the long term to get the desired results rather than just doing stock picking within a particular asset class. And in our fund, we are doing both. So it's not that we are not doing stock picking. So the model is built in such a way that it's going to do active asset allocation or dynamic asset allocation. The entire model is proprietary, which is going to keep adapting with market changes because it's a cross asset statistical model. Unlike a lot of other firms, which rely on, let's say, macro data or valuation based signals, in our case, this is a more statistical model and a cross asset model, which means that it looks at the entire fund or all the three asset classes as one, rather than looking at one asset class in isolation and putting a valuation signal on that. Right, so that's not something that we do out here in this fund in isolation. Right, so it has two layers of alpha generation or potential alpha generation. One is at asset allocation level, and second is at a security selection level, where within equities we have a separate multi-factor model which will help us generate alpha at a stock picking, and there is a separate model or a separate engine which will be run on commodity selection. Because in our case, to start with, the commodities where we are looking to take exposure will be gold, silver, crude, and copper. So we're looking to take exposure across all four of them.
Great, great. So, Bhautik, where do multi-asset allocation fund actually fit into clients' portfolio?
Sure. So the way I look at it is that, you know, most advisors actually already have multi-asset funds, right? Now, the challenge here is implementation. So maintaining the right allocation requires regular monitoring, disciplined rebalancing, timely decision making. As a number of clients grow, that becomes increasingly difficult, right? Now, when we looked at the industry data of multi-asset funds, what we saw was that at an industry level, right? So, when we looked at the last 5 year data, what we realized was that most multi asset funds, or at an industry level, out of 100 rupees, almost 55 to 60% of that is consistently invested in equities. And that number is largely remaining, consistent in band at an industry level. And the second thing that what that means is that if you have majority of your money invested only in equities out of the other, out of the entire three asset classes, that means that if that one asset class performs or doesn't perform, you're basically banking on that one asset class to do the job for you. Because majority of the money is there, right? And the second thing that you need to understand is even if I have 60 rupees out of 100 invested there, the risk allocation that equity attracts is a lot more than fixed income and a lot more than even potentially compared to gold or commodities. So, which means that even though I have 60 out of 100 invested in terms of exposure, but my risk allocation is maybe closer to 80%. So, in our case, we're not doing that. And we are giving all three asset classes potentially, equal amount of opportunity to kind of contribute to the fund.
So, Bhautik, who should invest in multi-asset allocation fund and what should be the ideal time frame?
Sure. So see, in our case, because our multi-asset fund can dynamically move from, let's say, 10% equities to 60%, a similar number on fixed income, commodities can also go from 10 to 40%. And our historical, so the historical data of our model shows that we've actually used these bands. Okay. Now, in our view, the way we look at it is that this is more like a core portfolio solution, right? Because every investor needs exposure to multiple asset classes over time, because no single asset class can outperform in every market cycle. So, in our sense, a multi asset fund can actually provide a diversified foundation through just one investment. And investors can certainly build around like a satellite allocation around it by taking certain thematic trades or tactical ideas. But we believe that this can actually become like a core allocation in someone's portfolio. So, to give you some numbers here, when we kind of backtested this over the last 20 years, our model, both layer one, layer two, which is asset allocation plus the security selection engine, it's managing to show results where we are looking at around a 14% compounded return with a volatility of around 7.5% and a peak drawdown of around 13%, 1-3. In the same period, to give you some context, we are not benchmarking ourselves to equity, but to just give you some context, in the same 20-year period, Nifty has delivered a return of around 11.5% with a volatility of an 20% annualized vol and a peak drawdown of 60%. So in some sense, our historical result shows that by dynamically allocating across assets, you're actually able to get equity-like returns with far lower risk.
Great point, Bhautik. Bhautik, many MFDs wanted to know that how can they simplify the concept of multi-asset allocation funds for their clients? In other words, how can they sell it effectively?
Sure. So see, the way we look at it from our fund's perspective, right? Let's say you have two investors wanting to take a journey in a car, right? And the journey in their car is to a destination, like investors, try to achieve a certain goal. Now, imagine taking one journey on Nifty and another journey, through this multi-asset fund. Now, in case of Nifty, what will happen is that, let's say in the last 20-year period, you've seen multiple bumps, multiple potholes. There have been multiple breaks in the journey, right? Because, for example, let's say you started in 2007, in 2008 itself, you saw a 60% drawdown in the markets. 2011, you saw, the Eurozone crisis pan out. So there have been multiple such scenarios which have panned out in the last 20-year period. Now, two things happen out here. One is that because a journey can be bumpy, it is possible that an investor may not even stick around for this entire journey where they're trying to achieve a particular goal, because they might just feel that this is not a journey that is suitable for me. It's extremely bumpy, extremely volatile. Let me get off the car and maybe go back to what I was investing in traditionally, maybe a fixed deposit or something like that. What we are trying to do out here is make the same journey a lot more smoother. And once you make it smoother, right, what happens is that there is a very high probability that the investor will probably just sleep through the journey because the journey is smooth, right? It's like taking a journey through, on Mumbai Pune Expressway versus going through the old Mumbai Pune road, right? Which is going to be smoother, which is going to be, less traffic, all of that, and
Right.
enjoyable. So that's exactly what we're trying to create with this fund.
Great, great, great. One last question, Bhautik. What makes Alpha Grep multi-asset allocation fund different from other multi-asset allocation funds available in the market?
Sure. So I would put it in two, three ways. See, the entire asset allocation decision are driven by quantitative models rather than discretionary views. One, the models continuously evaluate the changing market conditions and the opportunity across asset classes using large amounts of data, both in terms of market data, macroeconomic data. Second is that we begin the risk allocation rather than return chasing. So instead of asking like which asset class will generate the highest returns, what we ask is how should the portfolio risk be actually allocated most efficiently? And that often leads to more balanced portfolios across market cycles. And the third is that this strategy is kind of backed by Alpha Grep's institutional research ecosystem. We've spent 16 years building quantitative capabilities, supported by hundreds of researchers, technology professionals. So there is some meaning to this entire infra, which is available at a group level. So for investors, this would basically mean that they're not simply just buying another multi-asset fund. They're accessing an institutional grade quantitative investment process that has been built over many years and now available through a mutual fund format.
All right, we have come to an end to this interesting session. Thank you so much, Bhautik, for your valuable time and inputs.
Thanks a lot, Nishant, for having me here.
And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.